Good day, everyone. Dr. K and Gil Morales coming at you from different parts of the globe. We see that Syrian tensions are easing today, and the GDP came in above expectations, so it's causing a market rally here. Also, we are still you might have noted that, and GDP hit the walk for the block is
I don't know, we're losing you, Dr. K.
strange.
Yeah, you're warbling out pretty good here.
Well, I'm not talking right now. Let's see. Let me change one thing, and that might help. Okay, how's that?
That's better. Let's see. You want to start over? I think we missed most of
it. How's that?
Even better. Even better.
All right. Okay, so start from the top. Syrian tensions are easing. We've got the GDP that came in above expectations. Both are causing a market rally. We could also argue that the dead cat bounce is still in play since the markets have been selling off for the last 4 weeks. You might have all noticed that when the GDP news hit the wire before the market opened, the markets had a sell-off. Reason being that strong economy implies that the Fed may taper sooner than later. And we also see that outside the U.S., namely China and Germany, both of those countries may be also turning the corner, as the latest slew of reports have been showing economic strength in both regions. So, we all know that these economies do connect to some extent. So what's good for one is good for the other. And we're starting to see growing evidence that the global economy is at least doing better for now. The question is whether it can persist. You'll notice that gold and silver and also the Commodity Research Bureau, the CRB index, these are all turning up. And when the global economy strengthens, major countries like China exert bigger demand on these commodities. So that probably explains the upturn. And if you look at the long-term chart on the CRB index, you'll notice that it looks like it's trying to put in a bottom. And if you also look at GLD and SLV, the iShares ETFs for the respective precious metals, gold and silver, you'll also see that they too look like they're putting in some sort of a bottom. So the question is whether this economic recovery can sustain itself. And I suppose we'll just have to wait for the next few reports over the next 2-3 months to see if we've really broken the downtrend. Gil?
Excuse me. Choking on my tea over here. Let's see. Yeah, well, basically you have a market that is volatile, and I think we've been on the chat room. Those of you in the chat room, I think if you're not, you're missing probably the most valuable part of your subscription to VOSI, and you really should be there. And I think we need to have a lot more people on there. Actually, I think we get close to not quite 100 at times, but a lot of things going on in the market. It's whipsawy, and I think that, to me, the essence of what's happening here is you buy into strength and they whip you out, and then you sell into weakness and the stocks stabilize and turn around. So I've shifted my strategy to using, I think I talked about this last week, to using the 20-day moving average. I use the 20-day exponential moving average as a guide for stocks. If they can find support there, then I'll come in and take a shot. And we looked at this last week. This happened with LinkedIn right off the 20-day, and then it's able to come back above the 10-day. So if you're buying the viable gap up, you get blown out here, and then the stock turns around and goes higher, and it's trying to work its way higher. My guess is you'll move along the 10-day moving average. So what you want to watch for here is potentially a pocket pivot along the 10-day moving average. It seems to be holding up okay. A stock like Facebook, pulls in here, doesn't quite get to the 20-day moving average, but you'll notice what happens is you run up from here to here, then you retrace about half of that, which is a logical area of support, and then it turns around and breaks out again. You pull back in right on top, so you even could have been buying the other day, I guess. The question is whether you're going to make any real progress in terms of a major trend with the market. We might just be in a choppy area, so my approach has been to be a short-term trader, a swing trader here, looking to buy stocks when they look to me like they're ready to move, and once they get going, I may sell them when they run up. I'll give you another example. Netflix is kind of fun. It runs up, pulls in, and it's nice day trading stock. It's running up again today, making a new high. I'm not sure. We got to get above 306, I believe, before you get to an all-time high. But this stock's acting well. We've been noticing Tesla's trying to hang in real tight. It may continue to go sideways here, let the 10-day catch up. But again, the question is, where's the market going from here, and what is the potential for a sustainable uptrend? So, I think you're really left to this method of buying the stronger stocks on pullbacks when things are looking kind of ugly. And on the chat room, I've called this my ugly duckling theory of the market. Excuse me again. When stocks look ugly and patterns look ugly, a lot of times that's where they'll stop and turn right around and head higher. And that's what confounds, if you're using Standard O'Neill methods, I think that's what confounds a lot of investors in this market, is that stocks will start to run up and then they'll start to blow up, and then they're shoving you right out. And a good example of that is 3D Systems, massive breakout, stalls out on Monday, and then comes in on heavy volume. And the one thing that makes me nervous about this, I talked about it last week, is that let me pull up. I'm going to bring in my HGS investor software here. Is that if you look at let's take a 3D on a weekly chart. Let me make this a little bit bigger. You've got this big cup, and you got this long handle, and it's been going on now for about 16 weeks or so. And this is a I believe 41.9% deep cup. And now you got this long handle. Now, is this late stage? Is it trying to set up in a first stage? I don't know, but it's looking like it's taken a long time in here to get going, and it just acts volatilely in here. And it reminds me of First Solar back in. Let's go all the way back here to a little further here. Actually, we go back. It reminds me of First Solar back in 2008. So you have this deep cup. This is like a 49% deep cup, and the stock then went sideways. It tried to come out here, and then started forming this handle. And this handle, this sort of high handle thing, lasted about 16, 17 weeks, and then it blew apart. And you'd have these breakouts, and it looked like it was going to start to break out again, and it would fake everybody out, suck you in, and then blow you back out. And then, of course, Broadcom is actually, when I was thinking Fizzler was a short back in 2008, and I was actually at I think it was an IBD meetup in the Microsoft building in New York City, and I was telling everybody that I thought that Fizzler in 2008 was starting to look like Broadcom. And, of course, a lot of people, scoffed at that because at that point Fizzler was a beloved leader, and the Solars had been a hot group in 2007, and everybody was in love with them. But they were all breaking down and starting to show signs of breaking. But Broadcom, same thing. This is about a 55% deep cup, and then it went into this long handle, which eventually broke down. And so when I look at this, and I look at the First Solar back in 2008, and now I'm looking at 3D Systems, today. It makes me a little bit nervous about the stock, and it's real volatile. I think the action is kind of screwy, and it flips right out. But here it's turning around and it's going higher. So that's what makes this market so tough. And my rules generally, if you got a breakout and you fail in the breakout, I'm just out of there. I'm not going to mess with it and see if it sets up again. But the thing is, it seemed like you had to be buying into the weakness, and now stock's turning around and head higher. And that's kind of the story of this market, and that's what drives a lot of people crazy. Stratasys, another one in the group's acting okay. This had a breakout, it's doing okay. X1 is another one I've been keeping my eye on. Moving sideways, kind of tight in here. They're supposed to price I believe it's a 2.656 or 565 million share secondary, and they announced that on August 21st, which didn't really have much of an effect on the stock. It held the 20-day, and now it's hanging in real tight. The base might, looks like this right now on the base. A little bit of wedging action in here is kind of pulling in, so I'm not sure what to make of this in terms of the weekly chart. Maybe it's setting up to go higher if the group can go higher. So, but I find that the action in 3D a little perplexing, and so I don't always get everything right, but this one looks problematic to me, and it's kind of ticking me off, to tell you the truth. But in any case, Yelp is moving today. If you're on the chat room, we've been talking about this. Got support at the 20-day on the pullback. Again, you buy the Bible gap up, it runs up, and then it fails. And you get support at the 20-day, but notice it sets up along the 10-day. Technically, it's got to exceed this volume here, which was on August 15th, in order to be a pocket pivot today. It's moving. It's actually on track to do that.
Yeah.
It's coming in a little bit. Yeah, so it's on track to do it. Let's see how. But this, I just see this as a high tide flag, and we've been talking about buying it along the 10-day, and of course you got to buy it when it's quiet, when it's coming in. And you notice even after the market got whacked on Monday, the stock was able to hold in reasonably well on the pullback, and it looks pretty good. So I like this. It looks like it's going higher. Another one we've been talking about on the chat room is VIPs. VIPs actually beat earnings, and stock. You got to keep in mind one thing. Before earnings, stock had run up from below 30, below 25 if you want to go that far. But the pocket pivot was right around 30, and you run all the way up to 50. Okay, that thing's almost a double. Okay, so earnings come out, buy the rumor, sell the news, they whack it down, and you come back into the 50-day. If you look at the chart here, you have the breakout. Here's your first pullback to the 10-week moving average. So again, here's a stock that was strong. I've been watching it trade on the tape. It looks like the selling is drying up, and it looks like everybody on the chat room got to it before I did. But in any case, it's probably still in a viable range if you're willing to use the 50-day as your selling guide. But it's basically, it comes right back to the top of the prior base, and you're right into the 10-week line. You got this heavy volume in here. I've seen stocks that hit with 1 week of heavy volume. Doesn't necessarily mean it's a problem, but if you like, this sort of stock, it's a thinner stock, trades about 653,000. That's a little better than what I usually like to see, but it looks fine. So it might be worth a whack for those of you who like to buy this type of stock. A couple of stocks I wanted to talk about that I think you need to keep an eye on, and I like this one, Noodles. Anybody aware of this one? Somebody going back to VIP. Somebody asked me, the gap down on big volume doesn't scare you. Stocks may piss me off, but they rarely scare me. I just sell them if we get to that point. And again, I just want to point out that what I was saying earlier, you had this huge move, so you get a bit of this, buy the rumor, sell the news on the earnings, and it comes in, and with these center stocks, and they had a big run up, you get people like falling all over each other to sell the thing, and I think that's what happens. And so, that the gap down, that could bother you, but in this market, you see stocks do that, they'll hold in and then turn around and go higher. I'm just pointing out that, given that my method has been to buy stocks that are leaders on weakness rather than trying to buy, every strong move you see and then getting your butt whipped out instantaneously, I use this sort of method and try to come in on them this way. So now you're seeing the selling volume is declining after this break. You shake out all the the hot money in here, and then maybe it's able to turn around. But at least I think you're in a lower risk position here than you would be trying to buy up in here. So it's just something to keep in mind. And again, you start worrying about this sort of stuff. Yeah, the heavy volume gap down, but stock had a couple of those before it took off. So it's sort of its nature, and I think you have to look at something like this when it's acting weak and not so much buying into the strength. And I think the pocket pivot here was a beautiful spot to buy it because it's not very obvious. Anyways, a few of the stocks that I'm looking at, I like this Noodles. Going back to this, it's an IPO. It is started by the guy who started Chipotle Mexican Grill. I don't know about any of you guys out there, but if anybody, men or women, guys or gals who have kids, I think my kids eat way too much pasta, but they love noodles. And it seems like no matter what restaurant we go to, you know, they're always ordering this fettuccine or this spaghettini or whatever, and they seem to love noodles. So I don't know, maybe this is going to be a new concept that works pretty well. So I like this concept. I would keep an eye on the stock. It's in the process of building a flag formation. You get a nice little move up here. This is kind of wedgy on the weekly chart. You see that? The volume's coming down. It's a little wedgy, pulls in the correct set, and now it's trying to move higher. So maybe it pauses in here, and so far all we have is a 10-day and a 20-day moving average. But you might say, let's see, I was looking at this, 1, 2, 3, 4, 5. Let me see. Can I count? 1, 2, 3, 4, 5. I don't know. It's a little pocket pivot-y like, but it's a little bit extended. Here you have a pocket pivot, but you're 1, 2, 3, 4, 5. That's the 10th day, so a little early. But I've also noticed in this market that you can get pocket pivot-like moves if you see either an extreme dry-up or a pullback to the 20-day first, as in the case. Let me just show you, like with Yelp. This is something I was talking about. Something I've been using. If you get a pocket pivot within 5 to 8 days, or rather where you have volume that is higher than any down volume over the prior 5 to 8 days, sometimes it tells you stock's acting pretty strongly. And my method here has been looking for a 20-day bounce, get back above the 10-day, and you see how you had a little pocket pivot if you're only counting 5 days, because the volume is drying up here in the pattern, and so it's just an incremental increase in volume. Seems to give you a clue that this thing wants to move. So you could start buying along the 10-day if you're into that sort of risk. That's something I like to do. Little Bird yesterday told me to get heavy. This one around the close. I don't know why. I was just watching it trade, and it just seemed to me that it was going to move, and it's doing that today. So that's one thing I've been looking at. You can even notice if you look at Tesla, which bounced off the 20-day. You get this pocket pivot kind of move if you were only counting 1, 2, 3, 4, 5 days, and that would have been viable. So I'm noticing this in specific to this environment, but this is something that I do in real time because I'm a tape watcher, and I watch what's going on, and I watch all the little idiosyncrasies of what's going on in individual stocks, and then I try to figure out how to trade them. And in this market, I take a short-term view because the bottom line is we're still in a correction, and if you look at the S&P, the S&P is looking a lot uglier, so it's still a dangerous environment to try and come in heavy on stocks. And for me, heavy on stocks is going in full margin, just blasting in. I think if you go in 20, 30, 40%, and you test some positions, they don't work out. Maybe that costs you 1% or 2%. That's not a big deal to me. And I think you might, since we're down at the lows, this could be the extent of the correction. I don't know. We had this happen last time. Maybe we got to go a little bit further. Maybe the market's topping, who knows, but I noticed that there are ways to trade this market, but you have to be willing to buy on weakness, and it just seems like the strength, buying on strength, just whips your butt right out. So anyways, let's see. I'm just going to go through some more stocks here. I've become a big fan of Sprouts. I was going to Sprouts Farmers Markets a while ago because they're gluten-free, and that's my new diet, as you all know. And you notice this thing came public. Yeah, let's get this stuff out of the way here. Came public, it's forming a flag. It's kind of defined a range. So I look at this. Not a lot of selling in this thing. It's kind of a thin stock. Maybe you take a shot at it here. The earnings look pretty good. I kind of like it as kind of a play on a pullback here. All you have is a 10-day moving average, but you could probably watch it and see if you get a pocket pivot or something coming up through the 10-day moving average. On this day, you had sort of a pocket pivot move. It's a little V-shaped, so it's taking some time. But that's kind of interesting, and that's kind of a position I'll be willing to try out a stock. And in this case, down along the lows, this might be a low-risk area to buy the stock. I'm going to go through some questions now. We're at 8:21. We're 21 minutes into this. Just let me run through some questions so I can catch up on this. CRUS, some stocks someone's asking. Cirrus logic. It's basically trying to round out the lows of a base, but to me this is too weak. I'm not really going to be interested in this. Pretty erratic, coming back up. It's not really had some time to round out. You know, you could argue that it's trying to turn, but I don't know. It doesn't look.
It's too much risk in the pattern.
Yeah, I don't really care. But there are better names to be in.
Downs in the last several months in this pattern. So
yeah, it's junky. Oh, thanks everybody who's. Today is my birthday, believe it or not. So, somebody says they had a dream that I and Dr. K were doing this webinar from your house. Oh, that sounds more like a nightmare to me, but. Let's see. UVXY model had a rough August, down 37%. Does Dr. K still think this is a viable model?
Yeah, absolutely. I sent out a report on the UVXY and also the MDM in terms of how challenging the market has been since late 2012. And I mean, as far as the fine-tuning on the model, there's not really a lot of fine-tuning I'm doing right now. It's just the market conditions are right now very manipulated by quantitative easing, but also a lot of these cross currents, plus a lot of sideways action in the market. 100%.
You're breaking up again.
Yeah. That was.
Yeah, Dr. K, you kind of totally disappeared now.
Huh. Bizarre.
You're saying what? You said something about sideways action has made what the more difficult.
How's this now? How's this now?
Yeah, that's better.
Okay. Just saying that the sideways, when the market goes up 1%, UVXY can go up 10 to 15%, and if it, vice versa, if it goes down 1%, it can move moves in the opposite direction to the market. So when the markets don't move in a trending way like we've been used to for many years prior, the UVXY model is not going to function very well. And the issue is that it's impossible to predict ahead of time that the market's going to go sideways. So that's what's been happening since 2012. It's been a very difficult environment. So I'm not going to be tweaking any of the parameters on UVXY. I don't see a need to. I see why it's not working, and I also see that this kind of environment is quite unprecedented. And I do believe once the environment restores itself back to something a bit more normal, the UVXY will have some great performance. It's had two periods where it's had amazing performance, but the first time was in 2011, and it went up something like 521% in about 3 months. But the risks were also quite high, so I had to dial down the risks. But then in doing that, I also dialed down the reward. So then I had to tweak those to get it to where it could enjoy triple-digit returns and keep the risk at a minimal level. So that was working quite well for a while until late 2012 and all the way to present. I mean, the markets have been very unusual. So I guess the best way to say it is let's just wait for a return to a bit more normality in the markets. And for now, if you're going to do the UVXY model, of course, I've always suggested position sizing on the smaller side. And if you're losing, then keep your position sizes even smaller than that. It's kind of a turtle trick. If your account equity is going down, then you size down even less and less than the proportion of which you lost. So if you were at say 100 units, and then you had to draw down to 90, your position size would not be 90%. Your position size might be 80% or 75% of the norm. So you keep it. In other words, you keep ahead of the drawdown in terms of position sizing. And then when your account turns back to black, you can go ahead and you can do it in the reverse if you're aggressive, or you can just keep it on par.
Yeah, and I would say when it comes to this VIX thing, keep your eyeballs in your eye sockets. I know a lot of people, the greed factor comes into play because you see there is potential to make these huge gains very quickly. The only problem is they can be fleeting. You can see up here on the UVXY, big gains very quickly, but it's fleeting, and then eventually the thing breaks down pretty quickly. So unless you're able to handle the risk, you probably don't want to be messing with something like this. And I know some people will jump in here thinking that because there's some model that it's some sort of panacea for just profiting wildly off the UVXY, but it's not. In the volatile environment, it's going to be a little choppy, and you're basically playing short-term moves. For those of you who've been on the chat room, we've talked about using the 620 5-minute chart to trade the UVXY on this basis. That's one way to control risk, and I've talked about that many times, the 620 chart, and how it provides a basic guide in that regard. And I think that's something that can help you if you're trading this, because it seems like it works pretty well on a short-term basis, Dr. K, but trying to ride a trend necessarily, although you could say if you were short the VIX here during this period, you did okay, because that's a pretty nice downside trend, so you could have made some money there. I don't know how much to... Yeah, that actually would work pretty well. So, if you catch these kind of trends, it seems to be more uniform on the downside when that happens. The only problem is you could be subject to sudden whips to the upside based on some sort of news or something. So
there was a report we sent out it was essentially talking about using the XIV vehicle, because that one has had more or less a persistent uptrend, but there's periods in there where it will, it'll shake you out, and that's where the UVXY model comes in. So in other words, XIV runs opposite to U. It's a 1x, and the UVXY is a 2x inverse, inverse of the XIV. So essentially, for longer-term holders, you could play the UVXY model in the longer-term format, but basically what I'm looking for is markets to enjoy a trend at some point. As you all know, in the last few weeks, the markets have been pretty sideways, and that is a very difficult environment, obviously, to be trading and market timing. And when you've got a volatile name like UVXY in your hands, then of course the risk is that much greater in terms of getting cut up. And instead of losing 2 or 3% at a time, you're losing 10 to 15% or more at a time. So the money, the drawdowns can be quite substantial. And I suppose that is the aspect of trading UVXY, is keeping your position sizes small. If you get if we get a great run like we did in the second half of not in very late, not in December. That's when the problem started with the markets in 2012. But prior to that, the model did really well, and you can see that it more than doubled from September till all the way till November. So you can get some great gains, but then keep in mind that if you're position sizing, say 20% of your account, that's great. You'll double that 20%. But then if we go into one of these periods where the markets are going sideways, then you could easily lose half that amount as well. So you could double, then lose half, and be right back where you started. So keep in mind the volatility on these models, and ultimately, I do believe that once we get more trends and the market does return back to something a little bit more normal, I do expect the UVX model will be putting up some big numbers, and it'll still have its share of big drawdowns, but I think the bigger numbers will more than compensate for the drawdowns.
Let's run through some more questions here. Someone's asking about Cubist Pharmaceuticals. Well, I think it's moving in a flag, so it's something of a high type flag. So this actually looks okay on a technical basis. I kind of like it. I think we mentioned it somewhere back in here last week in one of our pre-market pulses, that it looked potentially like a setup, to keep an eye on here. I think you had sort of a pocket pivot right here, but it's stalled out a little bit. But it's acting okay. It looks to me like it wants to go higher. So it looks okay. It's a biotech with no earnings. So that comes that sort of stock. The risk comes with the territory there. So you got to be a little bit careful there. Any back testing on the 5-day pocket pivot theory? Well, I've noticed it. I don't know how long it lasts, but it's just something that seems to occur in this market, which has really been a short-term wiggle type of thing. So yeah, I see it on a number of patterns, and I also can just sense the action because I see the bounce off of the 20-day moving average, and I think holds tight along the 10-day, and it at least gives me a reference point to bail out. But again, everybody's always looking for some, magic rules that you can just follow by row, kind of like when you're driving, you got a stop light. Green means go, red means stop. You see stop signs, yield signs. So, people kind of want to invest on that basis. Not really my style. I sort of watch the tape and I try to adjust to what's happening in the market in real time. And in this environment, that's worked pretty well for me. Although there's some periods where I have to sit through some volatility, but if you're used to that, you can handle that. But I'm not afraid to take a shot at something if I think it's coming into an area of support, because that seems to be where they come in and buy these things, and then they sell them when they're up, and then they come in. So no, all that's to say is I haven't really back tested. I kind of put it out there in the chat room. If some of you guys want to go and back test it, be my guest. Here, Dr. K, here's one for you. Dr. K, you keep mentioning that the trend-following wizards are down in this QE market. Why do you think these wizards have collectively been unable or slow to adjust to the QE environment? That's a good question.
Well, they live and die by trends, and they're not looking to use to create any or predict what the market's going to do. So
warbling again. Warble alert. Warble alert.
This is brilliant. I keep changing settings.
Now you're hissing.
One more time. How's that?
That's better.
How's that?
What are you doing? It's are you like?
I'm just changing my toggling settings on the sound.
Interesting. And there.
So it seems like by changing it, it works for a little while, then it doesn't work after a while.
Yeah. Well, I'll just holler when I hear
really
warble.
Bizarre.
We'll just come out with a warble alert, and then you can adjust.
Yeah, that's good. Yeah, no, the wizards are all about, these guys have been around for decades, and they know that markets can get out of sync for whatever reason, but they're not looking to predict how long that lasts or to try to preempt it. They're just going to go for the trends. So while the trends have been very unfriendly since 2009, and really since 2011, I would say, it's been a real tough environment for them, and I'd say it's unprecedented. I've never seen these guys have such trouble, again, in their 20 or 30 or 40 plus year careers. But we know why that's happening. When you have the Fed manipulating like they're doing, and this is, you'd have to go, I don't know how many decades back to see anything that remotely resembles the kind of environment we're in today. When you have this manipulation, then you're going to have problems, and a lot of the tried and true indicators stopped working in 2009, as we know, and then in 2011, the general market just stopped giving us the kind of trends that from which we profit, and therefore the wizards are it's interesting because they're considered the guys that have been around for ages, running funds for many decades, and always coming out on top. But right now they're well underperforming the markets, and they've been down, I think, every year as a collective group since 2011.
So what does that mean, Dr. K, that everyone's gonna continue with their models until they're completely broke?
Well, they go by the whole thing that these periods change. They don't ever stay the same, and we know that tapering is going to start at some point. The market's dynamic; it doesn't just go in a straight line. So we know something's going to happen, and that's they're just waiting patiently. I'm sure they're all quite frustrated.
Yeah. Yeah, I know I am. I mean, the market direction model has had a difficult time, and we look at our managed account program A and B, which are down. I think one's down about 4.7%, the other one's down 5.6% for the year. But you have made some adjustments, so I have to give you some credit for that, because if you look at last year the performance was a lot worse last year, but you've been able to mute the downside by making some adjustments, but it's still been almost impossible to make money on a trending basis with the number of bad signals. But it looks like we've been able to keep the downside performance relatively contained given the fact that there were more bad signals in 2013 versus 2012. So, you can adjust the model so much, but I think unless you're going to completely abandon it or completely revamp it, you're kind of stuck dealing with it. And some of these guys, for those of you who've read Michael Covell's book, Trend Following, he talks about some of these trend following guys like Bob Dunn, where, he'll sit there for a year with his model just getting dinged and dinged, and he's down 50%, and then, of course, he'll catch a trend, he'll be up 200%. That's what we would be looking for with the market direction model, that at some point something's going to kick in, and you're going to have a signal where you make big gains, going to make up for all the bad signals you've had so far. That's obviously the theory that keeps market timers in the game. Some guys have closed up shop because it's just been very difficult. You were mentioning that, Dr. K, in a recent letter we wrote about some guys closing up shop in 2011 because they just could not get a grip on this environment. And it is a bit of a twisted environment. So, to make progress, it requires probably thinking outside the box and taking a contrarian viewpoint. And it took me 2 or 3 months of this year before I figured out that buying into strength is kind of a dumb thing to do. And what I needed to do was adjust my approach and look to buy into weakness and then trade out when things are running up 10, 20%. Just trade them out and trade them in sides. And that's worked for me personally, but in terms of pyramiding strategies, in terms of the market direction model, it's been very difficult. And when I survey a lot of Ken Slim type investors, I find that some are up decently because maybe all they had is Tesla and a couple other stocks that have done well, but a lot of people have had a lot of trouble, and some even down on the chat room, some is down as much as 50%, and that can happen and in this sort of environment. So you have to adjust. I think you have to be very nimble, and it helps to be able to watch the screen all the time like I do and get a sense of what the tape is doing. So all I'd say is that you got to stick with it, I suppose, and assume that you're going to have a period. So somebody asked a question, I think it's sort of relevant to this, that O'Neill talks about, right now one of his favorite topics is that we're about to start a major super cycle. And they define a super cycle as being, 10 to 15 years, and you're going to have 3 or 4 major uptrends of 3 to 4 years interspersed with bear markets. And you're asking, do we believe that this sort of thing is going to happen? I'll just take it as it comes. I don't know, super cycles. I think when you're selling newspapers, it helps. In an environment like this, I think people are getting disenchanted with the markets, and so you got to keep people in the game by giving them some positive hope, and the idea of a super cycle occurring, obviously is going to keep people interested, at least watching the markets. So, I don't know what motivates that viewpoint. I guess it's based on the fact that we have been through about 10 years of a secular, say, sideways market, and we're just trying to come out of this range. And so the idea, let me pull up my handy dandy. Let's bring up HGSI, and let's look at all market indices. Let's look at the NASDAQ. Whoops. Whoa, what was that, Dr. K? Is that a motorcycle in your apartment there? Whoops.
Drag racing going on here.
Here's a NASDAQ composite, and let's look at a weekly chart, a monthly chart here, going back. And this is essentially what you're dealing with. Here's 2000. So you've been in this choppy range, and so the idea is that we're going to break out and start a new super cycle. And if you go back in history, the 80s sparked a big super cycle that extended from 1982, I believe it was, 81, 82, into 2000. And, of course, then we've gone into this choppy, sloppy environment. And so the idea is that we're going to break out of this. I think if you look at
the big bull from the early 80s came after 17 years of choppy, go-nowhere action in the major indices like the S&P and the Dow. So that 17-year period where the market had to slosh around before it got traction. And then if you go back to 1929, actually if you pull up a monthly chart of the Dow and say go from 1929 to 1955, I mean it was...
Well, I can't do that on this system. But
Okay. Well, basically, it was. I would say that the market finally got traction. Well, it looks like about 13 years after the 1929 peak. It did have a good strong bull market that went for what looks like about 3 years, um, and then it went sideways for 3 years, and then it went had another bull market for 3 years. So yeah, I would say that with that market to top in 1929, you needed to wait about 12, 13 years before you got a good bull market on your hands. So maybe we're in that position now, where the markets maybe need, they need one serious bear market to wash it out, and then maybe then it's off to the races with the new bull.
yeah, I mean, I would tend to think that you're going to need to see, since we've been going since 2009, it's 3 to 4 years. I would tend to think that you're going to need to see a uh, a bear market, something to clear the decks, and I would also like to see QE end. Ultimately, I think that QE ending is going to be a good thing, but in the near term, if in fact if QE is all that's holding up the markets, then they pull that one out. You got to wonder how much we're going to correct and what kind of adjustment you see. But there's still a lot of weird stuff going on. There's a huge amount of debt out there. Does the dollar continue to devalue? Um, you know, we've seen the dollar.
Well, most likely, I mean, the long-term trend since 2001 has been lower, and with the Chinese being the super creditor nation of the world, and U.S. being the super debtor nation, I think there's going to be a transfer of economic power from the U.S. to China over the next 10 years. It's going to be very pronounced, and I think the U.S. dollar is no longer going to be the sovereign currency, say 10 to 15 years from now.
I don't know. I'm less impressed with China. I still think China is a basket case. Average median income in China is $2,200, where in the U.S. is $44,000. They're still way, way, way behind us, and maybe there's going to be a transfer of wealth. But a lot of that stuff, Dr. K, just for the sake of argument, let's spice things up a little bit here. It reminds me of the stuff, of Japan in the 80s. Japan Inc. is going to take over and surpass these all this other BS. I think that a communist country is inherently flawed, and I think the problem with the U.S. is that we are leaning more towards being socialist, communist, and that's our weakness. And if we move away from that, if we move away from that, I think we can still assert our dominance in the world. There's so many areas.
Countries have never moved away from that. That's the problem. They always go in that one direction, and I don't see that changing.
Be an exception?
I doubt it. I don't know why U.S. would be any different than Rome or the U.K. or any of these big countries. If you look at that, there's a chart of sovereign currencies going back 1,000 years, and you'll see that the average lifetime of a sovereign currency is typically 80 to 120 years.
Right.
And then it gives up its title, and I think the U.S. dollar, I don't see why it's going to be any different, especially the way the trends have been since ever since Ayn Rand's The Virtue of Selfishness came out in the 60s, where she talked about what could happen in the U.S. if they don't turn the tide. And of course, since the 60s, the tide's never turned. It's just gotten more extreme to her predictions that started to come true en masse. I'd say in the last 15 years in the U.S. And I only see more laws, more of the same thing, more government control, less personal freedoms, less economic freedoms in the U.S. And I think that's going to be the downfall ultimately.
Well, my view is, unless citizens stand up and put their foot down, things could continue to get worse. But I also would say that what does the crowd know? And the crowd knows that this is what's going to happen, and the U.S. is in certain demise. Maybe it isn't. Maybe it is. I still think that the U.S. is unique, and you can quantify that uniqueness in terms of the entrepreneurial component of our country, of the U.S. versus the rest of the world. I mean, Europe, there's no innovation coming out of Europe, at least not in terms of new companies. Where does Google come from? Where does Tesla come from? Where does Netflix come from? LinkedIn, all of these companies All of
Yeah,
this innovation occurs in the U.S., and I think
there's a,
that is what sets us apart. And I think
but
ultimately,
it's the trend I'm concerned about. In other words,
right,
yeah,
right,
I mean we're on top, but that top is eroding, and we're starting to see innovation coming out. Well, I mean Scandinavian countries, Estonia, I mean Skype. You've got pockets of innovation coming out in these other countries. Meanwhile, the U.S. still has holds title in terms of the best universities and the best creative minds and the best technologies. But the momentum seems to be decelerating, not accelerating.
right.
And
It's
that's
running
my
into some
concern.
potholes, sure. But
So
it's still, to me, it's still an open question, and I'm not, frankly, as a citizen of the U.S., I'm not willing to throw in the towel just yet, and I don't think anybody else is.
I see things a lot more holistically in terms of, I mean, I don't consider myself really, I see, it's a citizen of the planet because we all are connected, we all have been, and, economically, emotionally, we're all one. And so, I do see an evolved humanity, not this generation, it's probably going to take a number of generations to get there, but an evolved situation where people are not seeing borders and differences and separation, but they're actually seeing cooperation, which is much stronger than say competition, where there's a winner and a loser and often a zero-sum game. Where cooperation, as Wikipedia and a lot of these social projects have shown, is a very fast track to building and constructing something that's very useful for all of humanity.
Okay, well, let me just say I'm a citizen of the universe as well, but I'm not sure how that applies to the specific problem of turning the U.S. around and getting it back on track, because I do think
I think that can happen, but it's done in a holistic approach. In other words, a rising tide lifts all boats. So I do
right.
see, I tend to be very optimistic in general. So I mean, yeah, I think right now the U.S. is not looking good, and historically, sovereign currencies do come to an end, and so on and so forth.
Right,
But I
right.
think we're also at a turning point holistically for the planet where there is so much more connectivity than ever before, and that could be the thing that rescues the U.S. So instead of say the U.S. being clearly the world economic leader, what we could see is the U.S. and say 2 or 3 other countries providing huge amounts of jobs and innovation for the rest of the planet. But then we also see countries that are second and third world nation coming up and prospering from a result of the rising tide. So, in other words, right now we have first, second, and third, but say 50 to 100 years from now, those third world could be first world, and the first world could be, the new paradigm.
Okay, but what's going to happen? The U.S. is going to have to buck the historical precedent and turn it around. So
I think it's a big question of if that can happen because of history. But then again, sometimes with technology and at the pace it's going and the parabolic rise that we're seeing, and also this on the lines of the connectivity of the planet and how technology allows us to connect like we've never connected before. I do think we're so much more integrated as a whole unit. In other words, each person represents a cell in this giant organism. And in other words, when we see a cancer in the organism, that could be, say, a third world nation that run by a genocidal dictator. That would represent a cancer. I think we're much more efficient to stomp that sort of thing out and keep the organism as a whole healthier than say we were able to do this 50 to 100 years ago. So if you look at everybody as a cell in the organism, I do see the organism getting healthier and healthier, and therefore the U.S., which is trending in a negative direction in some ways right now, I think that trend could be reversed on that basis that the whole organism is getting healthier.
Okay, but getting back to the original point, I still don't buy into the idea that China is some juggernaut and is going to surpass the U.S. I really don't think their social system can pull that one off. But anyways, let's move along.
Yeah, well, then and of course there's the Goldman Sachs report that says India is going to be #1 ahead of China by I think 2025, based on their the power of their demographics. What's that? Sorry?
India may be a different story. They're a little bit more They've got the, as an Indian friend once told me, we have what makes us so much better than China is that we have the gift of the king's English. So, anyways, and being in London, I suppose you can appreciate it. Anyways, let's get these to some names. Ubiquity Networks. Someone's asked me about that. You know, it's sticking up there. It's up there. It's doing well. No cell signals, so that's all I can say there. AKR. I think this is Acorn Inc. Cheap stock. They had a viable gap up. You know, it's just holding the viable gap up. So it's not really a name that has hit my radar screen. Probably because it trades. You know, it's an $18 stock and it trades 659,000 shares a day. It's kind of thin. So, but you know, you have a viable gap up. If you think you want to buy it, you know the rules. But I'm not going to, you know, like I said, you don't need to have us blessing anything for you to make them viable or some idea that you have to pile in. Let's see.
Earnings are slowing down on that as well, and the sales. So, you know, with a thinner name, you want earnings and sales to look better than they're looking at for this company.
FXCM is a financial services company. These are a little bit slow. You know, I don't know. If you like it, you can. I guess you could own it, but it's just kind of hanging out. It's moving up to a $19 stock. Doesn't really thrill me. You know, find big stocks. That's what I would say. Someone says Dr. K needs to move to the West Coast of what? Britain? Isn't that Cornwall? Anyways. Oh, you're warbling again. Anyways, let's go to Pioneer Natural Resources. You had a little sort of a pocket pivot here. Some of these oil companies have been acting well. You know, it's got a pocket pivot. If you like it, I guess you can buy it. So I hope that answers the question. Another example of your buy weakness is PCYC today. Yeah, I actually had that on my list last night as I was going through my stocks on my HGSI system, and you know, right along the 10-day, the 20-day, right there, boom, and it gaps up today. So yeah, that's, you know, you might look at this, go, oh, I got to buy the pocket pivot or whatever, the breakout, and of course they slam you back in, and that's a pretty good, you know, break, because the high here is from 119.77. They take you all the way down to 110, and that's about, not quite, you know, that's an 8-9% break. So if you bought it and you're using a 7-8% stop, guess what? They just shook your butt out. So you know, that's sort of the thing I'm looking for. You know, another one I was looking at is RH. A little bit slow, started to get going, but you know, pulling in, I think it's lower risk to try and buy this because you did have some pocket pivots in here as it was coming up and around, and then you get this obvious move, and of course, what happens? They bring you right back in, and that's pretty frustrating. I have to admit, to the extent that I get frustrated by the market, and so, you know, but that's I think what you're looking for, and so PCYC is a good example of how you do this, you know, and that's why I'm nibbling on some of this SFM today. We'll see if that works. But yeah, that's me causing it to turn back to the upside, turn blue here on the chart, just so you all know. Can you think of other stocks like Netflix that had a big run, then cratered, then came back near all-time highs? Oh, there's a whole bunch of examples. If you go back and look at stocks like AOL, Ariba, Schwab, dry ships, so basically look at AOL like around 2000. Maybe I can do some of that here. Let's see. I'll just show you a couple. Let's pull this guy. Let's bring him out, the handy-dandy HGSI, all securities, and we're going to look at weekly charts. So let's look at, you know, if you look at, say, Schwab. Let's see, it's kind of doing it now, but if you go back to 99, you know, this is where it broke down pretty good and then came all the way back up. And you've seen this in a number. I remember Ariba was one. It doesn't exist anymore, but that was one that did the same thing. If you look at dry ships, what happened to dry ships? Not in here anymore. Is that, does that have a different symbol? Well, but yeah, I guess you can go back and look at some of these in our book. Yeah, but it's not showing up here.
That's weird. Must not be in their database, but it's certainly the same ticker. Same. They haven't changed.
Yeah. Okay. Well, I'll just use East Signal, and you can see dry ships was a one that broke down all the way and then turned around and went higher. That happens a lot. Green Mountain is trying to do that right now. If you look at the pattern, I need to shrink this guy. That's done the same thing. It's trying to come back to its old highs, and it's getting close. So, yeah, there are other examples. I mean, I think in most cases you can find a lot of examples like that, and it's basically predicated on the stock turning itself around and getting the fundamentals going again. Tango, I've been looking at the stock, but again, it's a cheap stock. It's a $20 stock. Had a nice move here, so it's acting okay. But not really one that I've been excited about. Somebody says that, I guess this is getting back to how people are becoming disenchanted with the market. I read CNBC viewers are the lowest since they came on the air. Yeah, and I think IBD is probably experiencing a drop in subscribers, and I think that's a general pattern for the industry at large, and I think that's that's an issue. But the more people become disenchanted, towards the end of the 70s, nobody wanted to have anything to do with stocks, and that sparked a new super cycle. So maybe that's what you're going to need to see, is people just become totally disenchanted with the market. So somebody says, this week markets are rising on lower volume and dropping on higher volume. This happening with the backdrop of QE tapering in Syria and a Syria strike imminent. Sounds like a dangerous environment for stock progress. I would agree, and that's why I've taken a short-term view towards the market in terms of trading stocks, looking to buy on weakness and then trade out as they move higher. So China will get old before it gets rich, and they don't have a supportive political system for freedom. That's a good point, because the demographics in China are terrible. Because of their one-child policy, they're less than ZPG. They're a negative population growth, and without a vibrant, and I think that's one of the things Dr. K, Europe's got going for it, is a very vibrant younger generation in Europe and those countries there. And I think that Europe might be a surprising place going forward on that basis, because I do think that, like you're saying, and the things you've told me about what's going on in Europe, that there is some evolution going on there to some extent, and they have a very vibrant youthful culture, I think, there, and I think that helps. And whereas China, and like Japan as well, they're just getting older, and the demographics don't seem to favor that sort of push. What's driven the U.S. in the latter half of the 1900s is the fact that we baby boomers, of which I'm on the tail end. I think you might be on the very tail end, Dr. K. Maybe you're not even a baby boomer. I don't know. But in any case, that's what's driven a lot of the growth in the U.S. is just the rise of the baby boomers. So Dr. K is a U.S. citizen. Someone said, I like this, Dr. K. How ironic. Dr. K says we're all connected and the audio goes dead. Good discussion.
Well, tech is not 100%. That's why it's important to be connected, so we can solve those problems.
Yeah.
And life is not 100% either, so, I mean, and if you expect it to be, and if you expect things not to go wrong, you're going to be in for a rude awakening. So you always expect the best, but prepare for the worst.
Yes, and Dr. K, you and I, we are connected through the cosmic firmament. We don't need Wi-Fi.
That's proven itself a number of times, yes.
When the USA starts knocking off Chinese products, then the trend has changed. I like that. That's nice. I was like some of the comments we get. More people agree that the demographics in China aren't so hot, and they're not. But we'll see how that all plays out. I mean,
China's a fast. China's has been in the lead in terms of the growth rates over there, and I think the Goldman Sachs report is it's basing it on how much momentum has been coming out of that country for many years, and when that momentum will peak and then subside. And therefore, by the time it peaks, China will have, I guess, moved ahead of the U.S. in terms of economic overall size. But because of their problematic demographics, I think India is going to then potentially move ahead. So these are all long-term projections, but they do make sense in terms of just the sheer numbers. And these emerging countries like China, they're going to go up in huge bursts, but they're also going to have very sharp setbacks. as is the nature of emerging markets. And that the same is going to be true with India.
Someone asked about Q. Not too much ads. You had a nice. They announced, I think it was a $365 million convertible bond offering. Maybe it was more than that. I forget. But that sent the stock down, bounced off the 10-day. It's kind of a supporting pocket pivot, but the stock's way up there. So I'm not sure I'd necessarily be buying into that. Somebody points out, and somebody says, instead of pocket pivot reports, you should send out 20-day support reports. That's actually a good idea, but I think what we'll try and do is in the pre-market pulse, I'll go through and point out some stocks that might be coming into areas of support that should be looked at. Now, it doesn't necessarily mean you got to go in and buy them heavy, but I think there are areas to watch, particularly if a stock has identified itself previously as a strong leader. So Zillow, somebody's saying, look at that thing. Here's a 5-day pocket pivot. It broke below the 20-day, got support at it, then got back above the 10-day yesterday. And you see 1, 2, 3, 4, 5 days. That could have been bought perhaps yesterday. In fact, I think someone was asking me about it, and it looked okay. Or I think this morning in the chat room it was being discussed, and now the stock's moving higher. So its cousin, Trulia, is also moving higher, and you'll notice here that it found after this big gap up, it fails, and it did find support just above the 10-week moving average on the weekly chart. So yeah, that does also become an area. You got to watch the 10-week line on the weekly and the 50-day line on the daily. Either or could come into play. This is a little bit trickier though because it's coming down for 3 days. Not a lot of selling, but now the group is turning. And with Zillow moving, this is also moving. Zillow's probably in a better position, but it would not surprise me if the market were to find its feet. It would not surprise me to see this thing, turn around and go higher again. Somebody says the U.S. future is dependent on our youth. Their values, they go easily to an entitled culture of values. I guess I'm going to have to interpret this and reformat. I guess it's dependent on our youth. Their values. As they go to an entire, I suppose their values, whether it's leaning towards an entitled culture or values of the older generations where pride and self-reliance was king. Once the government gives a handout, it never goes away, and socialism gets stronger until society tips over like Greece, or worse, when a dictator like Hitler comes out of the union powers of the day. Our youth needs to get informed and stop the government from taking away our freedoms. And this person says they are age 68. I would say that's true, but I would also, just looking at my own kids, I think my own kids are pretty smart and they're pretty aware of what's going on, and I can tell you they do not like what's going on, and they also find that more and more of their friends, particularly with my daughter in high school, don't really like what's going on, but they don't trust either party. It's not necessarily that they don't like Obama and the Democrats per se, but they don't care much for the Republicans either, and they sort of see what's going on with government in general and how it isn't helping them because it's not so easy for them to get jobs. Anyways, so I'm hopeful for the youth. I'm doing my part as a parent to keep my kids.
Yeah, but part of of course, the big problem is the educational system, which public education is really distressed in the U.S. And the problem is that it's so political that they can't get proper teaching methods into the into the public schools. The private schools, of course, the best ones are the best the world has to offer. But again, that's we're talking less than 1% of the population, less than 1% of youth in the States, of students, are privileged to go to those sorts of schools. And you've got the masses that are not getting the education they should. And that's why the U.S. tends to finish dead last in math and science. But then again, you still have the top 1%, which represents the best the world has to offer, and those are the ones that end up making it into Ivy Leagues and in Silicon Valley and whatnot.
COG had a pocket pivot a few days ago, so it's moving higher, acting okay. It's a but it's acting okay. Can't say much about that. Let's see. Someone says I'm getting more out of Virtue than IBD right now. IBD was a good learning tool, but Virtue fits my trading and investing style much better. I also say the chat room is a place to be. I'm just reading some of these comments. Everything under the sun is in tune, and the sun is eclipsed by the moon. That's a line from a Pink Floyd song. I like that. Away is trying to recover. It is, actually. Still looks kind of ugly to me, though. I'm not sure. I don't think it's identified itself as a clear leader pulling back on weakness. But just get some support on the weekly off the 200-day moving average. I think it's got a lot of overhead to deal with. I prefer Yelp. Yelp is the leader in this area, I think. Well, wait a minute. Home Away. I'm sorry. That's not what I'm thinking. I was getting that mixed up with Angie's. But Away, it's probably moving. Maybe it's moving with the Trillium, the Z. I don't know. It's a vacation, rental site. So it still looks pretty weak. Anyways. My daughter came home yesterday and told me that the teacher, her economics teacher, told her that she has to pick 2 stocks. They assigned this to the whole class, and the teacher says, I want everybody to pick 2 stocks, and then we're going to see where they are 2 months from now. So my daughter, having grown up with understanding how the stock market works, says, well, what if the general market is in a downtrend over the next 2 months? And of course the teacher's like, what? In any case, I think she likes Yelp and Sprouts. I think those are the ones she took in, so we'll see if they work. Somebody's talking about some QE. I want to get some questions so we can finish up. Everybody points out it is an unfair game with my daughter in the class. She was also asking, well, can I pick some short ideas? The teacher's like, what's shorting? So it's funny when it's gonna be interesting to see how that one progresses throughout the year. So because I'm sure my daughter will be at loggerheads with some of the macroeconomic theories being taught. I noticed the syllabus that they had for this class. They're going to discuss the ramifications of globalization. You know what that means. And I would say in LA, even the private schools tend to be somewhat left-wing. In any case, I don't see any more questions here. So, I don't know, like I said, if you're on the chat room and, you could have caught Yelp over the last couple of days, it's off and running. Maybe it pulls back in again. Maybe you're going to get $2.50 and that's it. I still like, you can see my little list here. I tend to like some of these stocks here. The VIPS is moving up off the lows. I don't know if that's going to work. Continue. 3D is just going to tick me off, no end. That's continuing higher. But the 3D stocks in general, you might also keep an eye on X1. It's trying to hang in there. Maybe that's going to try to move up and out of here. Stratasys also continuing to act well. But there is going to be more competition in the space, and we'll just see, how that progresses. Because there was an announcement, there's a Korean company coming out with a cheaper printer. So, I don't know. I'm still somewhat distrustful of Triple D after the action. Like I pointed out earlier, it does remind me of First Solar from 2008 and Broadcom in 2000. Last question we'll deal with, though, last couple of them here, is Apple. Stock had a pocket pivot coming up. You had this pocket pivot here down at the 50-day and another one coming up to the 200-day. You're just backing and filling here, and you got some resistance right in here on the weekly chart you can see. So it's trying to work its way through that. Maybe it goes higher. I can't really say that I'm inclined. You could have taken a shot, I think, down here, maybe even at the 200-day, but I'm not really inclined to buy the stock here. The moving averages are going to have to catch up, and you may need some time to set in here if it's going higher. But you don't know how much this is predicated on the news of Carl Icahn jumping in stock. So Alchemies.
And the earnings on Apple also aren't looking all that good, and they don't have any killer product in its pipeline. So I don't see Apple having the years it's had under its belt.
Yeah, it had its move in my view. So Alchemies coming down to the 50-day moving average. It's been an erratic stock. I don't really consider it to be a major leader. I think if you like this idea of buying stocks on weakness, I guess you could try it. But I would close out with one thing, is that you still have the Syria thing kind of floating around out there. So I'm still inclined towards taking a short-term view of the market, particularly with the indexes in positions where they're still really in short-term downtrends and sloshing around. Because if you go in long and if you come in heavy, or you're buying into strength, I think you're taking more risk. And I've already experienced a little bit of that. You know, I've tried some things on strength, like for example, this OCN. You know, Aquin had a pocket pivot the other day. I bought into that, and the next day they crush you. And in this case, I just get rid of it, let it set up again. You know, and the other one, NSM, is trying to act okay. That's doing a little better today, but there's no real volume on it. And so you see the index is coming in. So I think you're susceptible possibly to a pullback going into the weekend with a long weekend. Maybe that's when a strike occurs. I don't know. But you don't know how the market's going to react. So I think you have to be a little bit cautious here and take your short-term gains. VRX, another one here. I thought this one was looking good off the 20-day. And, of course, it breaks pretty hard. And what I didn't like here is here's the top of the base. I thought it should have held, and it broke down. And, you know, of course, you're going to get the bounce if you sold. If you bought some in here, which is what I did, actually, and then it starts to break, and you just sell it. And, you know, if you come in with a 10% position and the thing's down 3 or 4%, you sell it, what do you lose? 0.4%. Big deal, you know. It's really not that big of a deal. Usually if I buy these things off the 20-day and they don't hold 2 or 3%, I'm gone. It's coming back up, but you know, maybe the stock is going to try and heck, what am I? The stock kind of way up there. You know, maybe it needs to build a new base. It's a little premature buying it here. You do have this pullback to the 10-week line here on the weekly chart, even though it does sort of fail in the breakout. But yeah, it's kind of neither here nor there. I think it may need more time. So, not really one of my favorite stocks right now based on this action. And I guess that's pretty much all we have. But, you know, like I said, I don't think you need to go hog wild in here. Look for strong stocks coming into areas of weakness. You might try picking them up and see what happens, you know, and then look to trade out. And that's basically been my approach. I'm almost a quasi-day trader or a 2 to 3 day trader, and that's kind of what you get. In this market, and you could remain choppy for a while. So I think that's kind of where you're lying, and we'll just have to see whether the trend changes and things begin to improve. Dr. K, any final words?
No, I think keep your position sizes, you know, very on guard because we're going into the weekend. We could have some Syrian volatility, you know, starting next week. It'll be short-lived, whatever. If history's any guide, these sorts of things are little blips. And I think more importantly, we need to watch, you know, for the next emerging trend. Whether that's up or down, by you know, keeping an eye on leading stocks and the major indices.
Yeah. Anyways, that's all we have this week, you guys. If you have any questions, feel free to email us, and we will take your suggestions to heart as far as identifying stocks that might be that we might see as viable, pulling into logical areas of support, and that may be very relevant with the market perhaps coming down further. As some sort of Syrian action, you know, occurs, but who knows what's going to happen? You know, it could just be turn out to be nothing, and maybe that isn't even the reason why the market's been showing weakness. It could be something else, and so you don't really know for sure. So, anyways, on that note, we'll catch you guys next time, and everybody, good luck and take care.
So long, everyone.